Hello, good morning everyone. This is Pooja Tibeli. I'm the part of sales team. Today we are here with Mr. Seshadri Sen, Head of Research and Strategies. We welcome you on board, sir.
Hi.
Seshadri, can you please elaborate a bit on your recently released India strategy report?
Yeah, thanks. So we published something about middle of October where we warned about a short-term slowdown while maintaining the positive stance on Indian equities over a 2 to 3 year time frame. Some of those negatives have played out and in fact now look to be dissipating. There were three in main. First is of course political risk. We have a very busy election calendar coming up.
Yes.
We are now close to the end of the assembly elections, and then the entire momentum will move towards the national elections. It doesn't look like there will be any major negative surprises, but then that's the nature of surprises. You never anticipate them. We think the markets will be a little cautious and tread a little cautiously till there is greater visibility on the outcome of the national elections. But we don't see that as something from a 2 to 3 year time frame that really worries us at this point in time. The second is geopolitics, where multiple buffers, right? You got a fairly serious Middle Eastern crisis, which we don't know how that will impact oil, but thankfully after the initial spike, oil is now subsiding, so it's turning the other way, and that's visible in how the markets are behaving. Then there is the higher for longer and the US Treasury yield, which is creating unprecedented dollar strength, which is never good for India. And up until the point where the US starts cutting rates, there will be some volatility in the Indian market. The third is the weak monsoon, where we expect, especially at the bottom of the pyramid, some consumption impact in the third quarter. We will see how that pans out. Again, medium term, we are very constructive on the mass consumption theme. We look at it in reverse, that India can't deliver 6% plus consistent growth over a multi-year period, which is our base case, without the mass consumption thing playing out. It cannot be purely a pure K-shaped recovery which drives that. So those were the short-term factors. Having said that, we are very constructive on India in the medium term. We think that this is India's time, so to say. The well-known factors are, of course, the demographics, which in an aging world, India stands out. But what is enabling it in our view, and that's something that we are making the point that is not generally spoken about, is that this is an unprecedented period of financial stability for India, where the currency, interest rates, fiscal deficit, bank balance sheets and corporate balance sheet are all strong. We've never seen a period where everything is strong, and that will facilitate an extended period of growth for India. The second is the return of manufacturing, which is largely led by government capital spending, but to a smaller extent by private capital spending and relocation of in the post-COVID world, the supply chain diversification that is happening, which is benefiting India. The third is digitization, which is enabling faster growth for India. So we think that this is a 6-month blip where India will falter, when the markets will be volatile, will sort of be flat but volatile. But after, from the second half of next calendar year, or maybe even sooner, the bull run will continue. And we think that this is a multi-year bull run. We are in the middle of it. And we also think that there are lots of worries about mid to small caps. Sure, at the moment there seems to be some froth, but medium term, mid to small caps will drive this rally. Large caps will underperform.
So thank you. Next we will upcoming to the inflation. Inflation has been tamed effectively by RBI. So, but however, there will be some risk still remains. So, do you think inflation coming back again in the future?
Meaning that is a risk that we have to continuously watch out for, and so is the RBI. The last 5-7 years, the RBI has been conservative as far as inflation is concerned. They've not ignored inflation. There are many idiosyncratic factors to inflation. There will be supply chain shocks. There will be, we saw what happened in specific fruits and vegetables in the last six months. Those will not go away. And I think for India, the band is what, 4 to 6%, and it will overshoot that on occasion. I think. But is there a structural worry about India's inflation? No. Historically, Indian inflation has been very high, much above these levels, right? If you look at a 10-year, 15-year, 20-year inflation level, these are much higher than in the periods when it's 10, 12%. I don't think those are coming back, because the current policy thinking is that before it goes, and we saw that play out in the post-COVID world, where there was a slight delay when the whole world was debating whether to respond to what seemed like a supply side shock. But after some time, there was no debate, and India came down pretty hard. So the short answer is that at the moment there doesn't seem to be any risks. If you take a 3-year time frame, we will have to deal with these periodic bouts of inflation, but they are unlikely to be what the historic peaks have been, because right now policymakers are far more alert.
Yes. So considering these geopolitical tensions, the geopolitical tensions already earlier affected the markets. So, and again, do you think the markets have faced it maturely in the current times? And is this a real concern to the investors in the future? Or in the
You're absolutely right. Both in the Ukraine-Russia situation and in the Israel, the correction that happened immediately was more an opportunity to buy rather than a cause to structurally panic. But I don't think I would be as dismissive as to say that it's not a worry at all. One needs to, because this will have knock-on effects. Ukraine, Russia, I think, has largely settled down, though we will have to watch this winter as to whether it impacts gas prices or not. And as far as Middle East is concerned, we still don't know how that will play out. This is a fairly serious problem, and it does affect India's Middle East strategy to some extent. It is never good to be sort of you have to be vigilant about this. I think it is always good to be vigilant about oil prices, because one, India is heavily dependent on India, and if India grows at this pace, the energy intensity of India's growth will continue to rise. All the efforts that are being made in new energy, etc., will yield results many years later. So at the moment, if you take a 3-year time frame, if oil prices go out of control, it does affect India. There is no doubt about that. So one has to stay vigilant. For the moment, it looks to be controlled, but we don't know what the second order and the third order impact of this conflict is. It is a very severe conflict and has completely derailed the direction in which the Middle East was moving. Famously, there was one US bureaucrat who said 3 days before this that the Middle East is calmer than it's ever been. So if the US government got taken so much by surprise, it is very difficult to predict what the outcomes are. So at the moment under control, but you have to watch for this risk, because spiking oil price is not good for India.
Okay. Well, we all know manufacturing has been the theme growth in the emerging countries like China, and also some slowed economic downturn to the Europe as well. So, do you see India is well equipped to handle this global markets, and also what is the potential of growth you see in this?
Yes, I'd see a golden period for Indian manufacturing because of 3 reasons. One, of course, the changed geopolitical situation, where people are looking for supply chain diversification. So many companies are setting up facilities in India simply because they don't want to be dependent on China. Second is that the government policies have also nudged the Indian industry in that direction, and there are some policies like PLIs, etc., which are, and state governments are becoming more and more competitive, trying to attract investments. So that has loosened up the policy environment for manufacturing. The third is what I call the survivor bias, right? Any manufacturing company that has survived from the dark days of 2015 to 20, right, when growth was slow, leverage, is by definition strong. Operationally, balance sheet, everything is strong. So they are in a position. The demand may not be that as high as in the 2000s or in the pre-GFC period, but the companies are also much lesser. So any little demand is sparking a major growth for some of these companies because of low base and because there is no one else to try and compete with them. So yes, we think that manufacturing has a long run from here. Because the changed geopolitical situation and is favoring India at the moment.
Okay. So, which sector are you bullish on in the near term and the mid term?
So, the three sectors which we have flagged, which we like. So one of the things that we are saying is that there are plenty of sectors which look very attractive. India is growing, and most sectors from a fundamentals perspective, earnings growth perspective, many sectors are looking. But one thing that the post-COVID market has taught us is that even the best of companies, the best of sectors, if you don't get your valuations right, it is very difficult to make money, right? Yeah. Because many high quality sectors are going into 2-year winters, 3-year winters where the stocks move sideways and you don't make money. So one has to be cognizant. It's very easy to pick sectors that are showing strong earnings growth, but when one filters for valuation, the number of sectors shrinks. So the 4 sectors that we like are chemicals is something that we flagged, and we think it's on the reverse side of what I just discussed. Chemicals valuations were ratcheted up to unsustainable levels. And remember, most manufacturing companies go through cycles, mini cycles, even though the market was very consumer company centric pre-COVID, and everybody was used to secular growth stories. Manufacturing companies rarely deliver secular growth stories. So the cycle went a little soft. Valuations were high, and we got a 2-year winter. Some of them corrected quite sharply. Now I think the fundamentals are turning. Valuations have become more reasonable, and so that's one sector. It's a large sector with many companies. So that's something that we like. We don't think the hotels cycle has fully played out because supply is a long time away and demand continues very strongly. We like premiumization and aspirational spending as a theme in India. We think that as we move up the per capita GDP levels, you will find explosion in demand of some of these aspirational sectors, and hotels is one of them. So we continue to like hotels, and we like mid-cap financials, mid-size financials, because we think that the valuations there are yet to catch up with the large cap, and some of them are showing selectively faster growth and better improvement in ROEs than the large cap ones. So those are our top favored sectors.
Okay. So what do you think? Which sectors will benefit from the bull run on the manufacturing side?
Manufacturing is it's a very good question, because manufacturing is a vast plethora of sectors. So you've got industrials where one has to be selective because valuations have run up. Similarly with auto ancillaries. Auto OEMs we like, and their two-wheelers actually even today stand out. There are some stocks which are attractive. So Hero MotoCorp is one of our top picks. Then you got chemicals, which we just spoke about, and that's something. And the fifth is pharma. Some manufacturers in pharma are, and that's a sector that's not done well for a while. So those are the 5 sectors we think will benefit from the manufacturing story.
Okay. How do you see the current? How do you currently see the valuations across small caps, mid caps, and the large caps?
Large cap valuations are actually quite reasonable. Large cap, because they haven't performed also, so they are about 18.5, 19 times. Nothing to worry about. Earnings growth, if you look at Nifty earnings growth, etc. It gets trickier when you come down. We looked at, in our note, we looked at the mid cap index valuations, but those are less reliable, because one is that many of those companies don't have proper analyst coverage, and the way the data providers calculate is by taking analyst estimates, and many of them don't have or are not reliable. If there are only 2 analysts covering a stock, we filtered the Bloomberg universe for stocks which are covered by at least 10 analysts, and they're only to 275. So you know the lack of depth in the data. So one has to, as one goes deeper, one has to look at, and plus what happens with the small and mid cap is that it's far more heterogeneous, right? Some companies are overvalued, some are undervalued, and the index doesn't give you that sense. So one has to look at the individual companies per se, and we find pockets of overvaluation, certainly. Auto ancillaries, industrials, etc. Whenever I find analysts are struggling to justify market prices, then it gives you a sense of where valuations are. But that doesn't mean that you should walk away from the entire, because mid caps and small caps are the theme, and there are plenty of opportunities even within. You may think capital goods is overvalued, but within capital goods you find stuff that is not so overvalued and relatively undiscovered. So yes, there is some frothiness in certain parts of the small and mid cap space, but I don't think that there is a general overvaluation which will lead to a sharp correction in all small and mid caps.
Okay. So what is the growth outlook for IT, considering the slowdown in the global markets?
So IT has been slowing down for a while, and earnings estimates has been cut. This earnings season was actually quite poor, both from an earnings perspective and guidance perspective as well. Both saw negative. I think we are close to the end of that cycle. Further cuts look unlikely from here on. But the softness, our base case is that softness will continue. Having said that, recent US data seems to indicate that the US economy has been more resilient than anybody thought. And if we get out of this with a super soft landing, which some people are now talking about, where there is no material slowdown there's no there's no recession in the US, you just see a small slowdown, then actually IT could surprise on the upside as well. So the way I see base case is that it slows down, but that's in the numbers. The option value is that US gets a super soft landing and it takes off. So it's an interesting sector to watch from that perspective.
Okay. So the banking sector has been stable in the time of turmoil. So how do you see, what is the growth outlook you can see in the sector in the future?
Yeah, banking is a slightly complicated sector at this point. As far as fundamentals are concerned, growth will continue, but the levers for profitability are starting to have been all overused, and from here on, at least, credit costs and NPAs will bottom out. There's nothing alarming, but we've seen the best of those times. So it will deliver steady compounding growth, nothing super exciting from here on. And valuations are reflecting that. The large cap banks have been derated over a 3-year period. And I don't think they will go back to where they were because they were derated because the outlook has changed, and that will continue. So we are actually in a situation where we have a very constructive outlook for the Indian markets over a 3-year period. We don't think large cap banks will give you that. They may be good defensive holdings because they will compound at a steady teen rate. But they will not give you any outperformance from here on unless you are negative on the markets. Mid-cap banks selectively will offer opportunities. Mid-cap lenders will selectively offer opportunities, both banks and NBFC. But one has to be careful. We just saw RBI come down hard, so there are some areas for growth which. So the problem is that increasingly in the lending side, given the regulation, it is tough to make supernormal profits in any particular segment. Competitive advantage gets very quickly eaten away. So that has become a bit of a problem for the sector. So it's it's good steady compounders, but probably will lag the market.
So finally, your take on Sensex and the Nifty.
Well, as I said, next 6 months will be challenging, but after that, I think this market will recover, and I think if India grows consistently at 6% without volatility, then we should see earnings growth in the teens. There are, last year was depressed because of margins. This year is very high because of those margins coming back. From next year, you will probably see normalized growth. Okay. And you will see, and the market should perform along the Nifty and the large cap indices should perform in line with that earnings growth. But there may be a 6 months of slightly extended volatility.
Okay. So thank you for joining us on this discussion.
Thank you for.
We greatly appreciate your valuable insights, and we look forward again in the near future. Thank you
so much.
Thank you. So if you have enjoyed our valuable insights, so please like, comment and share. Thank you.